Hello and welcome to another episode of India and Global Left. If you are new to our show, please smash that subscribe button. Also consider becoming a YouTube member, a Patreon, or donate small amount given in the link in the description box. But the least you could do is to watch this show, like, share, and comment. Without further ado, let me welcome our guest today, Martijn Konings. Professor Konings is the author of the latest book, The Bailout State: Why Government Rescues Banks and Not People. He is a professor at the University of Sydney, where he teaches political economy. Professor Konings, welcome to India and Global Left.
Thank you. Thanks for having me.
We've been discussing neoliberal capitalism, among other things, with a range of scholars. And we thought that your book, latest book, The Bailout State, would be a nice follow up as a continuity about what we've been discussing. And so we reached out to you. Just for our viewers who haven't read the book, if you could give out the core of your book. As I read it, I felt that there were two critical elements. One is that the neoliberal state is an economically active state rather than a passive state. And the activity of that may not be in the fiscal sphere, but in the monetary sphere, although you warn in the book that these are not two separate spheres. And secondly, I think the critical perspective of the book is that it's not every corporation. You are talking about a very specific industry which is being bailed out, and its centrality within capitalism, which is the credit industry. But in the 90s and the 2000s, the credit intermediations, the shadow bank industry, and so on, which ballooned basically. So if you could give out the core of what your book is about, I think that would be a great foundation for our subsequent discussion.
Sure, absolutely. So, and I think you distilled the two key points quite well, actually. So, first to start with sort of the neoliberalism angle. Neoliberalism has been debated like tons over the past decades, and this has been very fruitful, and I've contributed to those discussions myself. But in the end, the idea of neoliberalism is very much associated with the idea of state retreat, that state minimizes its interference into the economy through deregulation, through fiscal consolidation, inflation targeting, all those kinds of things. And then people have been trying to sort of revise that, seeing that not all of those things are actually happening, and that actually existing neoliberalism sometimes does the opposite. But the neoliberalism framing has been quite sticky in a way. So in this book, I've really tried to say, like, well, the descriptor is useful to a certain point, but what it really obscures is the fact that the role of the state over the neoliberal era has not been reduced or attenuated, but increased dramatically. That it has become very intricately involved in the production of private wealth. So a lot of we tend to associate state and government intervention with sort of ameliorative measures, states helping out the people who got lost or didn't do so well in the market economy. But what you see over the past essentially 5 decades is that states have become more and more involved in supporting asset inflation and the wealth of asset holders. So there's this real shift from what you could call a sort of welfare state activism to welfare state activism, a state that is oriented towards, supporting the value of financial wealth. And then the other element you mentioned is that, yes, the bailout state is specifically about finance. Doesn't necessarily mean that only banks get bailed out, but they are sort of the primary constituency in the sense that over the course of the past century, they've become the nervous system of the American, Western, global economy. And therefore, when these institutions get into trouble, they have a particular claim to being bailed out. So these are not, decisions or sort of, corrupt political affiliations that make that happen. This is very much sort of baked into the system. And that is what the book tries to outline historically. And because I'm a little bit skeptical about the value of the neoliberalism label, I trace that through an engagement with Keynesianism, and show how it has really been Keynesians, progressive liberals, Democrats who have um, driven this construction of the bailout state, often against better judgment, often against their own intentions. And in that way, I have superintended the construction of the bailout state.
Yeah, if you could tell us a little bit more about your discussion on the neo-Keynesians, because they're just so contradictory. I mean, you define people like um, Rubin or Summers as neo-Keynesians, but a lot of people might not look at them as Keynesians, for instance. And you also
Mhm.
have a discussion on traditional Keynes work, which is, I think, his overwhelming concern was how to overwhelm the liquidity preference and make
Mhm.
unused resources flow into productive sector. I mean, he would
Mhm.
have spinning in his grave to see the rentier class emerging the way it did. But those who advocated for primarily keeping the asset prices high at the cost of everything else, uh, you club them as neo-Keynesian. So if you could explain on why neo-Keynesianism is so important in your analysis of this long history of American capitalism.
Sure, absolutely. So yeah, it's good to differentiate a little bit between Keynes himself, and then there are two sets of they're the neo-Keynesians. Those were, the people who popularized Keynes's thought during the 1950s and the 60s. Um,
So are we
and
talking about Samuelson and Solow, Robert Solow?
Exactly,
Okay.
yeah. So those are the people I refer to as neo-Keynesians with this very strong belief in fiscal policy and its ability to sort of drive growth and make a difference. And then the last category sort of are the new Keynesians. And I realize this is it's a little bit confusing because it sounds so much alike, but those are the terms that they've sort of used for themselves. So new Keynesians are people like Larry Summers who really um, are very sympathetic to the neoliberal critique and the neoliberal and monetarist critique of neo-Keynesianism, of that more traditional Keynesianism, which they see as responsible for the problems of the 1970s. It tends to be inflationary, doesn't really attach sufficient value to inflation targeting, a stable monetary currency, those kinds of things. Now, these critiques were already very much in train before, the 1980s, but it's really during the Clinton administration and then later also the Obama administration that this kind of new Keynesian way of thinking sort of acquires its, real world validation in a way, because um, until that point, there wasn't necessarily anything setting new Keynesianism apart from neoliberalism, just free marketeers, except for some, technical emphasis on market rigidities, but it didn't necessarily amount to much. Um, During the Clinton administration, it's really the expansion of finance that that directs the interest of people like Summers um, to like the contribution, the magic of finance, essentially. And Summers was one of the people who killed the more expansive. Summers and Rubin were part of the team that killed Clinton's more expansive public supply side program, which was very much focused on ambitious investment in technology and infrastructure. They, got rid of that. And so for a little while, it seemed as if Clinton's administration was entirely set for, a rerun of the Carter administration, just not really knowing what to do, struggling to sort of get growth going. And it was really the growth of finance and the dramatic expansion of dramatic growth of asset values that changed the dynamic, that this kind of tide of capital gains created that very thing that Keynesians are often after, typically after a generalized growth and generalized non-inflationary growth. And so the lesson that people like Summers took from that is that, well, we did it exactly right. This was not luck. We managed the budget deficit. We tightened the fiscal belt, and we let the Federal Reserve, the American Central Bank, just do its own inflation targeting job without political interference. And the reward for that was this, period of rapid growth during the 90s. And so that is, and so, and that becomes its own sort of conviction in a way. It's not so much an academic theory. Bernanke built on that dynamic, the theory of the great moderation. And then by the time of the Obama administration, this is also locked into their brains that they can't really see outside of it anymore, that they're, despite the great global financial crisis, which was such a huge event that clearly, called for far greater bailouts and far more, democratic forms of bailout. As soon as the banks were safe, their mind just automatically turned to austerity. How can we tighten the fiscal belt? And, gave the sort of the progressive game away there. And, and then you see people like Summers through the decade just kind of wondering, like, what went wrong? We had the formula right. We did everything. Deficit reduction should have been a plan for growth and jobs creation, but it wasn't. So new Keynesianism as a sort of paradigm, I really see as as a bunch of incredibly influential people when it comes to economic policy who generalized, who learned the wrong lesson from the 90s, and who then applied it to great detriment during the Obama administration, and tried to sort of roll out similar plans towards during the second half of the Biden administration when inflation started pushing up again. So that is kind of how I see new Keynesianism. So it's a little bit more, it's neoliberal. It's definitely neoliberal in some way, but it retains those strong Keynesian commitments to high growth, low unemployment, and this concern with how do we keep non-inflationary, generalized growth going. And then I think now we're at the point where they realize that it's just that game has gotten away from them.
Just to take a step back and think about the 50s, 60s, until the point of the stagflation in the 70s. Um, a lot of people think that there was a different regime, there was a different era. You've obviously outlined that there was a credit industry there which was constantly deregulated, and whenever there were high interest rates, it found its way to innovate other instruments, and all of those things blow up in the 80s. But nevertheless, those dynamics were always there. But a lot of people would say that they were not the dominant institution. So when we are thinking about the relationship between the state and its different industries, how fair would it be to think about the 50s and the 60s in terms of the credit industry having a dominant role when it came to the concern of the state, because in one of my research, I found that one of the FDIC chairmen later said that in the 70s, I guess, he was said that, oh, your job is so boring because banks don't fail, and who do you protect? And part of that was there was a regulatory framework, at least at the national level, even though at the local level there were many innovations. I was just wondering, I agree with you that placing capitalism in this long history is much more useful than just thinking of neoliberalism as something completely separate from the earlier post-war Keynesian capitalism. But it might be of interest to our viewers in how you might respond to this question that in the 50s and the 60s, the credit industry and the credit intermediation industries, they were not powerful.
Mhm. Yeah, no, that is a great question. So just to sort of background this a little bit, so the story that I'm arguing against is that idea that from 1945 till 1979 we had sort of Keynesianism, public regulation, commitment to full employment, finance suppressed, active fiscal policy, and then neoliberalism, starting with Reagan, sort of reverses all those priorities, and you have this sort of financial explosion at the expense of, Ford is the real industry. Now, that story is misleading, I think, but it's of course not entirely wrong either. Like it gets at something. So there is no doubt that manufacturing was a more significant part of the American economy in the 1950s than, let's say, credit unions. But what I'm trying to do by tracing that long durée is to show how the post 1980 era emerged out of what came before. So a lot of things that so we often talk about finance as being suppressed or credit being sort of embedded in the post-war American system. And once you start looking at it, that wasn't necessarily the case. It might look that way to us, but for people, living through that time, credit was dramatically more important than it had been to the generation prior. It was a key instrument in the New Deal to promote home ownership, especially, also various other things. And then once Keynesians were in power in the 1960s, credit expansion, especially for mortgage credit, but not exclusively, became this go-to way of making the economy grow. So Keynesians came in with this idea of, well, we're going to use fiscal policy to stimulate the economy. But that was often far more fraught than they thought it was going to be, mostly because it would push up inflation quite quickly. So whenever, and that is where they would first turn to certain supply side interventions, to basically trying to incentivize corporations through tax cuts and other incentives to change their investment and their pricing strategies in a way that would undercut inflation. So that is what you see happening to some effect, but not great effect. And then at the end of the day, it was always financial deregulation that gave Keynesians the most powerful instrument to kindle growth and to get the economy going again. Of course, it was a very, it was a bit of a double-edged sword, because you got a big, a huge sort of effect out of it in the short term. But in the longer term, it of course created new kinds of problems. It sort of grew the financial sector in a way that became quite dysfunctional during the 1970s. So yeah, like it's really about sort of tracing where it originated, these dynamics. And even if you look at this idea that austerity, specifically in neoliberal policy, it's not really. It's like you can go back to the 1950s and 1960s and really see that austerity fiscal policy is a response to the inflationary problems that Keynesian growth programs generate. So all this was in play much earlier than people often imagine it was.
Yeah, I think it might be a good place to ask you a little bit about your discussion on inflation. I mean, as I read it, it's a big part of your book, although you don't necessarily deal with the question of what caused inflation. What you are dealing with is there was this obsession within Keynesians, but also
Mhm.
conservatives, that inflation is very directly linked to the question of unemployment. For conservatives, it may be like the overall supply of money,
Mhm.
but the wages and levels of employment have always been at the center of it, the Phillips curve, as we know. But what you're perhaps saying is that there is something bigger within the dynamism of capitalism that might be in part because of the necessity to keep investment flowing, or else there would be a deflation that has a structural propensity to inflation. And that became a plank for some of the later day changes that came. That's how I understood it, but I would be curious
Yeah.
about what was your objective about keeping inflation so much at the center of what you were discussing.
Okay. Yeah, and you summarized that very well, actually. And I'll try to sort of reword it a little bit. But so, sort of my discussion of Keynes, there I make the argument that one of the key arguments the Keynesians often make is that capitalism, left to its own devices, is deflationary, right? It sort of has this leak, maybe driven by consumption or other, but basically, Say's law doesn't work. Demand doesn't automatically create its own supply.
The leakage
Uh,
of effective demand, as Keynes would write in his general theory.
Exactly. So by that logic, the Keynesian solution makes perfect sense. You plug the gap. You get the government to come in and compensate for those troubling dynamics. Now, and then there would be no problem. Then you would have an inflation-free economy. You have compensated for the deflation. Now, what I'm saying is that way of thinking doesn't necessarily make that much sense, and that I try to reconstruct that a little bit through Hyman Minsky's reading of Keynes, who really does not think you can start with, a monetary standard as if it's already there. Money only like a stable monetary standard only emerges through the process of de-risking any number of assets. Money is this sort of public-private thing. You can't just sort of designate a public standard and hope that it will stick. It needs to be sort of embedded in the whole system. And how that works is by the state providing financial guarantees to different parties to make sure that they all agree that this money is safe and sound. Now, once you do that, that means that the process through which a monetary standard occurs happens through governments putting a floor under the value of particular kinds of assets. So the capitalism as a sort of hypothetical system is neither deflationary nor inflationary, but capitalism as it exists has an inflationary dimension built into it because we need a stable money that needs to be propped up by public guarantees. So once you have that, and I think Minsky understood that in a way that Keynes did not. But once you have that framework, um, the logic changes a little bit. It's not anymore the case that fiscal policy can compensate for a deflationary trend, but fiscal policy is faced with the task of stimulating the economy, even though there might already be an inflationary bias embedded in the system. And that really becomes the difficulty for post-war Keynesians, that they will have situations where growth is low, unemployment is high, but inflation is already simmering. So um, the, so what can they do? Well, they can try to increase the fiscal stimulus, but that immediately pushes inflation up, and they have to retreat. They get these stop-go policies. So that is really what leads them to these supply side policies, which they use to, they're really saying like, well, pure demand stimulus is needed at some point to drive growth, but prior to that, we need to work on the supply side. Clearly, we are working with patterns of investment and pricing that aren't serviceable to us. And so we need to use the public purse and our regulatory authority to change the logic there. And that leads to a whole series of tax subsidies, regulatory subventions, and exemptions, the publicly funded training programs. And over the course of the 1960s and 1970s, you actually see that the tax structure of America's tax structure becomes a lot less progressive than it was because of this constant need to subsidize corporations and wealthy households. So that's where the thinking around inflation went. Sorry, I feel I missed a. Oh yeah, so the supply sider take is that you can look at inflation and sort out its specific causes. So that's what the famous Phillips curve is about. If you can work out what degree of wage increase causes inflation, then you can deal with that through wage price measures or union negotiations. But of course, it was never that simple because inflation is a more systemic phenomenon. And so supply side Keynesianism really got caught in this dynamic where it would always try to compensate for something that was fundamentally beyond its grip. And yeah, so yeah, let me just leave it at that for a second.
Yes, I guess I want to go to the 90s and then probably come back to the story of inflation where I would probably offer a critique. But something I wanted to pick up about the 90s, apart from relying on asset price inflation, you mentioned briefly about the rise of the middle class, and your definition of the middle class is that those who would have surplus after their wages, and those surplus can be now poured into financial assets, and they saw that regime of inflating asset price as something that was helpful for them. Housing prices, but all kinds of stock market prices. And I think that struck me because I've been also thinking about how people in parts of the global south, like India, and when I say global south, like India, it is a story of neoliberalism, or let's say reform and opening, which is not like China, where for China it was massively successful, but it was also not like Pakistan or Ghana, basically countries which have been facing balance of payment crisis. And a lot of middle class have become cheerleaders of this reform period in India. And part of that has to probably do with to some extent, rise of housing prices. And if you inherited a house, you grow richer. If you could talk
Mhm.
about how unprecedented number of people in the United States joined the financial markets, the 401k and other measures, and how that probably changed the popular perception of the centrality of asset prices within the political economy.
Yeah, absolutely. Um, the the third wave program of the Clinton administration, they really had a program of like financial democratization, right? Like people can be, um, people can get ahead not simply by working, but also through investing the right way, buying a house, financial markets, what have you. That seemed to fall flat initially. But once financial markets really took off, that idea suddenly seemed pretty viable. And to people living through it, I think it mostly did not seem like, a fluke event that would sort of, crest before too long and then die off. It seems like quite a well, in fact, the new Keynesians were there to reassure people that this was a new secular trend that they had mastered. The financial governance techniques to such an extent that we could now forever live in the great moderation of low inflation and high levels of asset growth. And this really, I think, the time frame for this would probably be like 1995 to 2007, because, and that's probably where it ended, because the Obama administration really refused to, do what it could have done, namely to bail out, the large segment of homeowners that had been caught out during the financial crisis. So, but nonetheless, I think that the period where the democratizing asset economy was roaring, like, has left a huge uh, sort of legacy on the imagination. I think you can still see it in debates around, stablecoin and crypto coin. There's clearly the idea of a riskless, an asset that has no risk attached to it, but will generate a return, that has become very deeply embedded in people's understanding of the global financial system, and that kind of invites people to participate in that dynamic. Yeah.
Um, it, a key part of your book is that the Federal Reserve is very central to the story you are saying. And it is tied up with, I mean, there are shifts, twists, and turns about its relationship with the Treasury, but nevertheless, it is caught up with the Treasury, and eventually it gets caught up with the shadow banking industry. And once the Glass-Steagall was repealed in 1999, and the commercial banks and investment banks and insurance companies, they came together, it was basically a universal industry. And the Federal Reserve had a big role within it to play. I mean, it was effectively being able to keep interest rates down at that point in time, and be very reluctant to hike the interest rates. I think it was 2003 or 4 where the first wave of hike came after constant cautioning from many. But eventually, when the crisis hit, the bailing out was the bailing out of a particular segment, and it is effectively keeping Wall Street alive, which which of course evades a depression-like situation in the United States. To that extent, they were successful, but nevertheless, it had enormous implication in terms of rise of asset managers, their political and economic influence, in terms of dramatically escalating inequality, and so on and so forth. Can you tell us the role of the Federal Reserve in pumping more and more money to these class of financiers?
Sure, yeah. So the Federal Reserve has been sort of formally independent since the early 1950s, and its task was inflation targeting, keep inflation at a low and stable level. During the 50s and 60s, they were still, open to political influence in a way, because they needed to negotiate that inflation target with the employment target. And then with the neoliberal turn, that employment target basically dropped from view. It's still there formally, but they became fully focused on inflation targeting. And the key person there is Paul Volcker, who saw this system that the system that was just where inflation was going out of control. And he actually did see that the role of the Federal Reserve was to sort of keep that going. So quite unsentimentally, he just said, we're going to stop doing that, understanding that he was going to cause like a massive economic crisis, which he did. And that over the course of the 80s, that did bring down inflation, primarily through a huge amount of bankruptcies. But where the story then kind of changes a little bit is that Volcker was also very aware that even though all these bankruptcies needed to happen, it was also of paramount importance to safeguard the nation's largest banks and the payment system, because if you couldn't protect the nervous system of the American financial system, the whole ship would go down. So during the 1980s, you see the Federal Reserve, protecting interests, organizations, companies where it needs to, and doing that effectively enough that things don't collapse.
So
Then,
effectively, they saved the bigger commercial banks, the continental
yes,
banks, and
yeah.
so on, and they probably let go the thrift industry, the SNL banks. This, as a side note, this resembles so much with Deng's, on a very different context in the 90s. He said that when there was a privatization wave of the state-owned enterprises, we're not talking about banks, but he said, let the small go and the big consolidate.
Banks that are too big to be allowed to fail get bailed out, and smaller banks can go bankrupt, and it doesn't have any systemic effects, which of course also created huge incentives for banks to grow and conglomerate and make sure that they reach that too big to fail threshold. But then at that point, the bailout genie has been sort of let out of the bottle. And that becomes, now people know this is possible. It becomes a part of how people anticipate the future. It becomes, built into expectations. And then, of course, Volcker's successor, Alan Greenspan, doesn't have to deal with too many direct, near collapses, but he basically creates what you could call a backstop state, where every time the financial sector threatens to get into trouble, he would use the Federal Reserve rate to make sure that they could access the liquidity they needed in an appropriate time frame. So you get all these, this proliferation of mechanisms for ensuring that large banks, can stay liquid.
Yeah, this was also the time in 1994. I don't remember if you mentioned it in your book, but the 1994 Interstate Banking and Branching Act
Mhm.
that came up, that basically allowed smaller regional banks to go national and eventually international. Followed up 5 years later with the repeal of the Glass-Steagall and the Commodity Modernization Act that left the derivative markets open, effectively creating that universal banking sector, which got correlated with the repo market and the housing market. Um, I wanted to bring up something that I didn't find in your book, and this is not necessarily a critique, but I think a reader from the global south of US economic history. Something that I found missing, particularly because in your discussion, inflation is so central. And in your discussion, interest rates stabilization is so central because it was basically in the 90s when interest rates came down that allowed a lot of these innovations within the credit intermediation industry. And I think
Mhm.
that story effectively is a global story, and you don't
Mhm.
capture that as a global story. I mean, others have done it, but inflation, of course, if inflow of cheap commodities, starting with oil, but also Chinese and other commodities. But and then the surplus in the sovereign wealth funds from the Gulf monarchs and also eventually China allowed a lot of the innovations that they were able to do. So it was not necessarily um, out of what they were in full control, but it was also facilitated by global conjunctures where that kind of Keynesian stimulus through tax subsidies and investment credits and so on were not necessarily feasible in the 1980s and the 70s, became a reality in the 90s and the 2000s.
Yeah. Yeah, and I think you're completely right. That whole train of thought I'm very much on board with. And that is not in my book. I do think there's a certain dynamic that I want to trace. The dynamic as you just laid it out, I do want to trace in other countries. Um, so partly that is just sort of, the limitation of, subject matter, the limitation of sort of, like existing expertise. But to the extent that it does, what the book does try to do is to disabuse Western liberals of their fascination or preoccupation with the Keynesian state and sort of the Bretton Woods period. Because whenever we start thinking about, you know, economic development outside the Western world, that's where people's minds go. Like how do we bring that back? Some kind of Bretton Woods arrangement within which um, individual countries could find the appropriate, monetary and fiscal policy mixes that will stimulate their development. And I think that is just such a Western story that has such a huge blind spot that I wanted to use this book to say, like, well, we shouldn't be nostalgic for that period. I don't see that much value in following people like, Danny Roderick and celebrating the idea of a potential return to Bretton Woods because that is gone and it's, perhaps it was better than we have now, but that's not the point. So reconstructing and showing how the post-war Keynesian welfare state was very much a geographically delimited um, arrangement for a privileged core of white households in Western countries. Um, it only could have worked. It had to work on the basis of exclusion. It is not something we can hope to universalize. Um, so to the extent that the book had a more global orientation, it is to draw attention to that and to criticize this sort of framing that we now see a lot where people, lament the rise of, rentier capitalism and those kinds of things, as if we could only get control over the rentiers, then we could go back to sort of Keynesianism. I just think that is a very debilitating political position to take, rooted in nostalgia.
Yeah, I think my concern is the same, and I think probably because I come from the global south. I mean, one of the things when I started interacting with leftists primarily from the global north, they would talk about neoliberalism, but in their discussion, in their critique of neoliberalism, there is this constant shadow of a fascination with post-war
Yeah.
Keynesian capitalism. And so even the politics is restructured by harking back to a past which was apparently golden. And the problem
Mhm.
that we face in our part of the world is that there was no such golden phase of capitalism. And in some ways, neoliberalism doesn't come up as this necessarily escalated class war in a very distinctive way of, I mean, it has some facets of class war, but it doesn't necessarily have other facets of wreaking havoc to your industries and, shrinking your formal sector. Not at least not in India. One can think about other parts of the global south, which was relatively more formalized in terms of labor. But in India, for instance, just 5% of labor had been formalized throughout the 50s, 60s, 70s, and 80s. And so there is not much informalization that has happened with the phase of neoliberalism. Something that have happened is that destruction, or let's say a freeze of the public sector and therefore a relative shrinkage of the public sector vis-a-vis the overall economy, which is effectively expanding, has been compensated by rise of the service sector and other private sector formal jobs. But effectively, the formal sector has remained the same. And I think it was in this regard, I was thinking that a lot of a lot of the inflation management or access to cheap capital has to do with the global south story. I mean, one can think about the commodity flows in the 90s and the 2000s, but one can also go earlier and think about US corporations activities in Latin America and how they basically robbed Latin America of bananas and whatnot. And so I was coming from the same perspective, but it struck me differently.
Yeah, no, that is very interesting. And there's something, so in the book, my criticism of the sort of supply side Keynesianism is a little bit to say, like, well, you can try to boil these causes of inflation down to their individual components, but you're kind of missing this sort of broader dimension, this more broader systemic dimension where these, and the way this gets fought over. But I completely agree that it is very, the sort of this new focus on supply side issues and people arguing that, there's no such thing as a general price index. There are just lots of different prices. Um, that is actually very important. And, because of the, geopolitical shifts and supply side reconstitutions and the next few years will see dramatic shifts in there. And you're absolutely right. You will need to understand, the origin, how this is going to shift at its origin in the places where, certain resources are, produced or exported from.
I think where I want to end, if we could spend like the last 8 or 9 minutes, I want to end with a discussion with you about a question that you raised at the outset of the book is how to democratize this bailout
Mhm.
state. I mean, your book is almost like it gives a mixed feeling. It's mixed in the sense that it says that capitalism has always been public, so it has never been this private. And this is something which many understood, including Marx, that it's the socialized nature of the economy that allows capitalism to happen. And so there are institutions that are perhaps there that might be, I mean, some might be dismantled. I mean, military industrial complex, which doesn't feature in your book, might have to be completely dismantled. But there are other institutions which are there that might be socialized and democratized in a more way so that we don't get a militarized state at the expense of a welfare state. Um,
Mhm.
so I think and that I think also I would be interested to hear your take on the whole inequality literature, because I think your book does offer something to that literature. I mean, Piketty's Capital, for instance, is an empirical work which shows that this rate of return on capital exceeds the rate of overall growth, and so there is a structural propensity towards inequality, shift, in favor of the asset holders as opposed to working class wage earners. But what I think your book is less vague, and it pins down to a concrete process of saying that this is how the state under capitalism looks like, and this is how the state effectively creates conditions for inequality, which we are all grappling with. So I wonder what your thoughts are on this massively rising inequality, because if we were to rebuild an alternative to capitalism, we have to tap on this tremendous frustration among people against rising inequality.
Yeah, I agree. Let me take your first question first. So, has has this always been political? And my question would be very much yes. I think that um, states um, politicize certain kinds of property in ways that serve them, and that creates a privileged stratum of property owners. Now, you know, that kind of makes sense, of course. But what is interesting about this in our time is that we've gone through a whole period where that kind of wasn't supposed to be the case, right? You really had to go dig, and that whole story that I did at the beginning of how a stable monetary standard can only emerge through like de-risking certain assets. You know, in the 90s, you really, that would have been like a borderline crazy idea, right? Like, these are just banks regulating a monetary standard. What are you going on about? Now, more recently, it has become much more visible again. And of course, the big giveaway there was quantitative easing. That after the bailouts, you get this dual regime of like draconian austerity, draconian fiscal austerity for the bulk of the population, while the owners of financial assets are treated to this regime whereby, the government freely just assures and increases the value of those assets. So, that makes the political aspect much more pronounced. Um, and of course, the only defense that the Federal Reserve had to that was like, well, this is exceptional. We're always trying to get out of those positions, but they never did. And, at some point, it was clear that they probably never would. So once this has been so politicized, it's like movement, or it's paradigms like modern monetary theory that, show up and say, if we can do all this, why can we not, you know, they if we can bail out banks or backstop banks, we can do the same for any number of other useful social activities. We can secure full employment. We can fund daycares. Can fund healthcare. There are no actual financial constraints, and I think, like, fundamentally, I'm on board with that idea. Um, the politics of MMT is a little bit too much like proving that the deficit doesn't matter. And of course, that's, the big beautiful bill is proving that again now. Um, and they don't really understand that that doesn't necessarily translate into the kind of politics you need. But so because they sort of trivialize the politics of monetary democratization a little bit. That is kind of why I went back all the way to Keynes and say, like, well, Keynes according to Lerner, Keynes was MMT. He said like, if Keynes is right, we can afford whatever we can afford whatever we can afford whatever we can do, I think is the phrase. Um, and so the book then traces all the problems that that project runs into. Um, and then by the end of it, like I think, I make a case for a renewal of that project. But that is not, that is more rooted in a sort of a financial democratization project that doesn't hope for technocratic fixes. It doesn't hope for, you know, if you can only get your hands on the levers of the Treasury or the Federal Reserve, you can do this or that. This is really needs to be a democratic movement that sees how much inequality has been produced through these mechanisms, which brings me to your other question. I do think so. A lot of inequality research is quite, tries to parse different variables, try to figure out differences in mobilities. And to me, that is all very important, but it does strike me a little bit as um, it does have a blind spot. And the blind spot here is that the American state is comprehensively committed now to um, propping up the values of the wealthy, the asset values of the wealthiest Americans um, in a way that we haven't really seen before. So, and that's why you sometimes use the term like the welfare state. Like the American state, despite neoliberalism, the American state is still as big and pervasive as it always was. It's just that now so many of its benefits have been shifted from welfare to welfare. And you can see this in like things like the way subsidies have over time shifted from like certain uses to like towards homeowners. And of course, like, all the tax breaks for billionaires. So there's a definite, like the regime is quite political now. And I think that means that we need to ask slightly different questions about, we're not fighting the 1%, let's say. The 1% is clearly not in any sort of instrumental way in cahoots with the state, but is massively subsidized by the American government using a very Keynesian program to do so.
Yeah, and a lot of that subsidies are not necessarily fiscal subsidies, but monetary subsidies that
Yeah,
come in the
that's
name
right.
of quantitative easing. But these are mostly asset price inflation to save capitalism and also save the mandate of capitalism so that the upper class doesn't revolt. Something to our shame we couldn't discuss much, but I would have liked to discuss was how much of freedom does policymakers have in this hyper financialized political economy, given you do mention, although not a detailed exposition of the bond vigilantes. I mean, I think there was um, I'm not sure if it was in Carter, but definitely Clinton, when he came to power in the mid 90s, he was definitely rebuked by the bond vigilantes that you cannot expand the deficit or we'll just push up the borrowing prices for you. And then you said that Obama understood that and he never tried it. And now Trump, who is otherwise so unhinged, if anyone could beat him up, it's the bond vigilantes.
Well, we know that whatever the real freedom is, it's hard to know because you would have to test it, but whatever the real freedom is, it's much higher than democratic governments typically say it is. They're so committed to their austerity programs, to their fiscal retrenchment, and then Republicans come in and they splurge on, the most obscene kinds of um, things, tax cuts and lots of things for people who don't need it, and nothing happens. Here and there you might have like a downgrading of a rating, but these are minor things. Now, perhaps this time with the big beautiful bill, it will be a little bit different, but I don't expect it will be very different. So so while it is true that, the American economy is in a global system and it's not immune from, capital flight or, bond vigilantes at all, like, it is exposed to those forces. Um, we know that the degrees of freedom that Republican administrations have shown that exist would have been more than enough to reconstruct American society in quite far-going ways. It means that Obama could have done things that would have given him a completely different legacy. Um, yeah, so like this is the story that this sort of democratic story of like our hands are tied, the money's gone, we can't do anything. That is just plain wrong. It's never true.
Right, I agree, and I think it is more true for the United States than any other because even with the trade warfare, I think like we haven't seen massive capital flight. I mean, we have seen some increase of bond yields, but that's about it. With when the war escalation with Iran happened, I was tracing the currency market, and it was all the currencies of the emerging markets that took a hit, and not the dollar. Dollar was appreciating against it. So I think this nonsense that we can't do anything because there will be capital outflow is just a concoction. Well, Professor Konings, it was a pleasure to read your book. Every time I read a book, I learn something new and I feel good. But every time I get to discuss with the author, I feel that I'm not a bad reader. I'm joking. Thank you so
Thanks so
much.
much. You're a very good reader. You really got the key points from the book, and I feel very privileged to have had this discussion.
Thank you so much. Have a nice day.
Hi, my name is Ayushman. I, along with Jyotisman, have started this platform. In the last 2 years, we have tried to build content for the left and progressive forces. We have interviewed economists, historians, political commentators, and activists so far. If you have liked our content so far and want us to build an archive for the left, I have two requests for you. Please do consider donating for the cause. Link is in the description below. Also, if you are not able to do so, don't feel sad. You can always like our videos and share our videos to your comrades. Finally, don't forget to hit the subscribe button.